Well, we know the Bank of Canada did raise rates last month after a 5-month pause, noting that monetary policy was not restrictive enough. Last week's report showing Canada added 3 times as many jobs as forecast in June, as well as persistent wage growth and core inflation are fueling forecasts for another 25 basis point hike tomorrow. For more on what we might expect from the Bank of Canada and some of the key factors behind its interest rate roadmap, joining us now is David Johnson, Professor Emeritus David, at Wilfrid Laurier University. He's also a fellow at the C.D. Howe Institute and a former researcher at the Bank of Canada. Thanks so much for joining us today, David.
You're welcome.
I'm getting back after a long weekend here. Got to get back in the groove here, David. So when it comes to what the Bank of Canada is really looking at as it heads into this decision, we've got a lot of data since its last meeting. What do you think is jumping out the most to the central bank as it heads into this decision time?
Well, the most timely data about the Canadian economy, and in fact, in many ways, the only timely data, are the measures of inflation from the Consumer Price Index and the measures of labor force activity that are published. Most people think of the unemployment rate, but there's actually a number of other measures in the report called the Labor Force Survey, which looks at a large random group of Canadian households and tries to understand what's going on in the labor market.
So in terms of the Bank of Canada's concern, you think it would be the strength of the labor market right now? That could be a factor that sort of pushes the bank to hike again?
Well, yes, it's the information they have. And I mean, another way of thinking about it is in the monetary policy report that they published in April. So 4 times a year, the Bank of Canada, for now quite a large number of years, makes a pretty significant effort in their publication called the Monetary Policy Report, which comes out every 3 months. And they really try to tell people a lot about what they're thinking. And in the Monetary Policy Report in April, they told everybody that the labor market was strong, that the level of GDP was larger than potential. And I don't think they would have seen anything in the labor market survey from the one that was just announced and the ones before that would think, oh, we need to change our mind. That's one way of thinking about the new information arriving. It's they have a very complex problem to sort out. They have limited information about something they would really like to know more about. So one way of thinking about it is, did the new information change our mind? It's a little bit like thinking about global warming and saying, oh, well, we had a cold day yesterday, so I think we should change our mind. Well, that isn't enough evidence.
Right. No, that's a good point. Yeah. And in terms of, if this data hasn't changed the central bank's mind, and like you outlined there, it likely hasn't, do you think that requires another rate hike by the central bank, or could require them to just wait it out a little bit and see if what they've done so far is enough?
Well, that is also a challenging question and probably not one that I'm best suited to answer. They began increasing rates really in January, and they had 2 big rates in October and December of 2022. The usual wisdom on these things is that it takes 6 to 12 months for a rate increase to have much impact. And if you think about it, that makes sense. The primary mechanism for the Bank of Canada rate increases to have a large impact on the economy is as people renew their mortgages. So for the people who have variable rate mortgages, they're going to pay more, or at least they're going to feel poorer, because even if their payment stays the same, they're not repaying as much principal. So those people, the impact is immediate, and it's immediate on other kinds of debts that are tied to the prime rate or the Bank of Canada rate. But mortgages are typically not or many mortgages have a term, and they kind of have to wait for those mortgages to come up for renewal, and then they renew at a higher rate, and then the household that has the mortgage outstanding has to say, well, if we keep our payment the same, it's going to take longer to pay it off, so I'm a little bit poorer. Or if I'm going to have the same payoff time, then I have to increase my payment and I'm going to feel a lot poorer. And you can see, you can imagine having 10 friends, and those 10 friends would all have mortgages come due over the next 4 years. And therefore, they wouldn't all be impacted immediately.
Yeah. And
then there's people like us who would look at an interest rate increase, and because I'm old, that's what emeritus means, partly. And, we're people with assets like GICs, and we're actually perfectly happy if interest rates go up. We think it's great. We're richer.
Right. Yeah, so and one day that will roll off my tongue a little bit easier, David.
There's a group of people in society who are perfectly happy and, in fact, would spend more if interest rates go up.
When you look at, you're talking about mortgages and, what people are, some people are having to face when it comes to that, the variable rates or what have you. The housing market has also been a curious one to watch over the past couple of months, heating back up when the Bank of Canada decided to pause back in January. What do you think the Bank of Canada is thinking when it's watching the housing market? I know that it is, most focused on inflation. But when it comes to seeing that activity, increasing again and prices even ticking up a bit, do you think that that's reason for concern for the central bank?
Well, it certainly wouldn't be a thing that would lead them to say, well, we need to cut interest rates more, because we don't fully understand what leads to a price in a house, right? But at least part of it is that if you believe a house is going to continue to rise in value, you'll pay more for it today. And I'm trying to collect my thoughts a little bit on that. The first thing you said was very true. The Bank of Canada makes a pretty clear claim that they are not directly interested in housing prices, nor are they directly interested in the impact of their interest rate changes on the house prices themselves. They don't pretend to try and control house prices. They wish they set an inflation target for the increase in a broad set of prices, of which housing is actually a pretty large component of it, and we might have time to come back to that. So when they see a house price tick up or down a small amount, they probably don't get terribly worried, except they do understand that housing is such a large portion of people's wealth. And if they're in the ras, as house prices peaked and then dropped, people clearly felt richer and clearly spent more. They spent out of the equity in their houses. And that clearly contributes to aggregate demand and continues to put pressure on wages and on prices and makes the labor market strong as people spend more. And so they would care about house prices mostly through that channel. They would say, if house prices fell by 20%, then would understand that people would spend less, and maybe we wouldn't have to increase interest rates as much.